Hi everyone, Buffett and Beyond proudly presents to you the stock of the week, and we're going over Netflix, which has been up 38% so far in 2023, and yes, it's in the entertainment business. Now remember folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's see what Netflix does. Well, it's the world's largest digital television network. And yeah, it's bringing in a lot of competition, but it's the largest and serving approximately 240 million paid streaming memberships. And 240 is in italics because they just came out with new numbers today. Over 190 different countries, and on 4/23, that's this year, they announced that the DVD by mail will end 9/23. Folks, I didn't even know they had DVDs anymore. Anyway, reportable segments, U.S. and Canada account for 45% of revenues, and international 55%, has about 12,800 employees, so it's a pretty big company. All right, now let's look at Netflix and how it compares with the average stock. And the average stocks are in blue, and we're talking about these vertical lines, and Netflix, and we're looking at 5-year averages. Netflix is in green, so we can see that the return on equity, you think of your bank account, how much money do you get in your bank? That's your return on equity. And we can see that Netflix has a double the average stock return on equity. And when we talk about net income, how much income is the company actually making, or profits, we should say, we're looking at almost triple the amount of the average stock. And then revenue, how much does the company bring in gross? Well, Netflix is bringing in twice as much as the average stock over the past 5 years. But let's take a look at the yearly results rather than the 5-year averages. Because don't forget, we had a year like COVID in there someplace, and here we are right here, 2020, COVID, and we're looking at net income, which are earnings that are cleaned up. In other words, we don't have non-recurring items. We don't have stock options for employees in there, and on and on. So we're looking at 2020, $6. It was making $6 per share. 2021 went up almost double. Then in 2022, it went down a bit because it lost some subscribers, or didn't gain as many subscribers as was projected. Now for 2023, the number is up to 1150, and right now, it was down from 1250, then this is about 3 or 4 months ago, but new projections just coming out this morning, this could be as high as $11.85. Now for next year, they're projecting $14, and we have most of the analysts averaging a little over $15 per share. So we can see that this company, or these numbers right here, may be understated according to the average professional analysts out there. And when we look at the return on equity, and folks, here's your money. How much money are you spending on each share? How much money is the company bringing in per share? And we are looking at 27.6% for next year. Now, the average stock returns about 13% per year. And to get into our growth portfolio, we want to see 20% or above. And folks, we certainly have it here with Netflix. Now, how much money is it retaining? In other words, how much of the money that it's making does it put back into the company in order to grow? Well, Netflix is growing at I don't want to say 100%. It's putting 100% of the money it's making back into itself in order to increase its market share. Now, net income growth for next year, 21.7%. Remember, the average stock out there is 13%. So, yeah, it's expected to grow next year. Revenue for the average stock is, remember, 7%. Well, it's going to be 11% for next year. So these numbers are coming up nicely. And don't forget, down here in 2022, let's look at this whole 2022 in here. We are looking at the numbers increasing now that the economy is getting better, and Netflix is really the clear leader out there when it comes to streaming. And years to pay debt, folks, it's doing very, very well there. This is Buffett's rule of thumb. He says if a company takes all the money it's making, puts it back into itself in order to grow, how many years will it take to pay off the debt? His rule of thumb is 5 years or less. Ours is 3 years or less, and this company can pay off its debt in 2.3 years. In other words, we don't have to worry about the debt of this company as interest rates rise. So that's a very good thing, very comforting to have this stock in your portfolio when it comes to debt service. And let's look at how the stock did in the past 12 months. Black line is the S&P 500. Black line is up about 16, maybe 17%. And here's the numbers as of this morning. 15% rise in Netflix just this morning. And so here we are up here at almost 50%. So we're looking at tripling the average stock out there. And don't forget, actually, the average stock out there hasn't done anything this year because the S&P has some tech stocks in it, or a lot of tech stocks, and some semiconductor stocks in there. Well, if you take all the stocks that are in the S&P 500 and treat them equally, then they have gone up nothing this past whole year for 2023. Why does the S&P 500 that we see here showing like a 16, 17% increase? Because Apple and Amazon and those type of stocks and NVIDIA are overweighted in this type of index. So the average stock has not moved at all this entire year. The S&P 500 capital weighted stocks, in other words, how many shares outstanding times the price, you got Apple, you got Amazon, you got NVIDIA. And folks, that's what this indicator is showing us. So again, almost 50% for Netflix, while the S&P 500 is up about 17, 18%. And over the past 5 years, this is surprising because Netflix was doing so well, but you can see, now this is 2023, this is 2022, and of course there was a recession in the stock market, maybe not the economy, but the stock market for sure, and Netflix took a big, big hit during last year because Disney was coming in with their streaming. Other companies were coming in with streaming. Netflix, they thought, was losing market share. Wasn't losing market share. It just didn't gain the market share that the market wanted because it was truly a growth stock. And look, since then, this stock has come all the way back and doing very, very well. And now it sits right here at plus 20%. For the past 5 years with the market up 60%, but boy, this stock is coming back fast. And as we saw in the charts before, that this stock is making twice as much as the average stock. It's growing more than 3 times as fast as the average stock. So we think Netflix has a long way to go. And let me show you something here. This is Netflix. And this is 2023, 2022, 21, 20, and 2019. And we can see that in 2019 and even the beginning of 2020, the highest price was around $400 a share. So let's see how much the company was making back in 2019. So we look at 2019 and we see that it was making $4.13. What do they expect to make in 2024? Well, this chart has $14. The average analyst out there says $15. So between 2019 and 2024, we're looking at almost a 400% increase in the amount that this company is making per share. Let's go back. This was the price in 2019 when the company was making $4.13 a share. And what is the stock priced at now? It's priced the same as it was back in 2019. However, right now it's making, or projected for 2024, it's projected to be making 4 times this amount here. So if we go by how much money the company is making per share, we should see a price all the way up here in the clouds someplace. So that's how we look at stocks, and we say, what were they making back then? What are they making now? And if they're making a lot more now, like 3.5 to 4 times as much, or projected to do that for 2024, then we think by the end of next year, this stock is going to be way up here. So we like Netflix. It's in our growth portfolio. And remember, folks, if you want to live on this beach like Jimmy Buffett once said, you've got to learn how to invest even better than Warren Buffett does now. All right, folks, we'll see you next time. Stay safe and stay well.